Most traders don't lose because they're bad at analyzing charts. They lose because they're competing in a market where they get the information last. And when you get everything last, you make every decision late. Late entries, late exits, late reactions, late understanding. Today I want to break down the exact information gap that can destroy traders. I want to show some real chart examples and explain how professionals trade based on the why, while retail traders based on the what. So what is the problem? Why do day traders always get wiped out? The biggest problem for day traders isn't their discipline, it's not their psychology, and it's not having the worst strategy. It's the fact that they're trading in a market where they get the critical information after the move has already happened. Most day traders wake up, they draw their lines on their chart, they draw their boxes, and they think that's enough. But while they're waiting for that break and retest, institutions are reacting to real information that retail traders don't even know exist yet. This is why you'll see a candle nuke your stop loss out of nowhere. It's not because your setup was wrong. It's because your setup didn't include what actually moves the markets. Institutions receive breaking news in under 100 milliseconds. Algorithms interpret and trade it in under 300 milliseconds. 70% of an earnings related move happens in the first 60 seconds. 85% of intraday volatility is news driven. Retail sees the headline 30 to 90 seconds later, if at all. So day traders blame the candle. They blame manipulation, they blame liquidity grabs, when in reality, they've just been trading blind this whole time. Now the punchline of this is day traders analyze candles and professionals analyze the reason behind the candles. One is guessing and one is informed. And nothing exposes this information gap better than the tariff news. When the NASDAQ dumped so fast that most day traders couldn't even process what happened until around 10 minutes later. So what actually causes the giant red candle? Let me show you exactly how fast the markets can change. This is the NASDAQ. Everything looks normal. You're lining up your trade, you're waiting for your model to take some longs back up to this Asia high, and then out of nowhere, boom. Please take in, this is on the 30-minute with this giant red candle, a full market-wide nuke straight into your stop loss. This is the part every day trader knows. Your SL gets hit, you stare at the screen, you're thinking, what the hell was that? Did someone manipulate this? Did I mark my levels wrong? Was that a liquidity sweep? No, it wasn't manipulation. It wasn't your box that you drew out. It wasn't a fake out. It was news. And this came absolutely out of nowhere. A tariff headline dropped. Institutions got in instantly. Algorithms dumped the NASDAQ within seconds. High-risk tech positions got unwound within the first minute. Meanwhile, retail traders found out around 10 minutes later after checking Twitter, Discord, and news apps wondering why did the NASDAQ just drop over 140 points in one candle? You didn't get that headline, you just caught the consequences of this leg. And this is where the entire game changes because markets don't move randomly. They move because information enters the system. To understand the information gap, you need to understand what professionals see in real time. The first thing is they have instant headline feeds. Bloomberg would be the biggest one, and that directly feeds headlines almost instantly. Second, there are AI news scanners that read the news before humans. And yes, institutions have AI that reads economic releases and earnings PDFs faster than you can even blink. Third being order flow, delta, footprint, imbalance data, everything that shows buying absorption, hidden liquidity, and real-time shifts with intent. And four, sector rotation dashboards. Funds can see money rotating out of tech as it happens. The core lesson here is by the time you see this candle, institutions already know the story behind it and have positioned themselves already. So the solution to all of this is stop trading noise and start trading catalysts. A lot of traders think that day trading is the path to consistency, but day trading is built on randomness. Random 5-second volume spikes, random liquidity sweeps, random intraday noise. When you study catalysts, the events that actually move markets, everything becomes a lot more clear and you take a lot higher conviction setups just like this one right here. I waited almost 10 days for this move to form, but I had such high conviction in the market structure and in my macro bias that I saw virtually no drawdown on this trade. The reason macro and market structure trading wins is because it gives you context. Price makes sense when you know the why. Moves become somewhat predictable. News turns into a reaction, reaction turns into a pullback, and a pullback turns into a continuation. This repeats every single day. Next is you avoid around 80% of the noise because you're not trading randomness, you're trading events. Risk becomes more defined. You're trading the market repricing information, not guessing what might happen. You're aligning yourself with how professionals trade, and institutions don't trade on random candles. They trade on actual catalysts. Now I want to show you what this looks like on the chart. So obviously the first catalyst being this massive sell-off of tariffs, and the first reaction to this was obviously the massive dump. Now the first reaction to this is obviously to recover at some point, and during Asia session we had this huge recovery and then right back and retesting this swing low right here. Now we did have the continuation back to the upside a couple times, and we continued making higher highs, as you can see from my market bias right here. So after continuously making bullish market structure, you can see the bullish pattern forming. You can see this area being retested right here. If we did break below this area, I would think we would be in for more of a sell-off and I would have positioned myself to the downside. With how Trump looks at the markets, he doesn't like the markets being down for too long. Mind you, this is back in October, but back in October, we didn't really have that much risk to the markets besides those tariffs. Now, those tariffs did pose a massive threat to us, but overall, with the other companies in the NASDAQ doing so well, it really only made sense that we were going to continue up. We had very clean structure going all the way to the upside. That gave me the confidence confluences I needed from a market structure perspective, being this first higher high being made, breaking that higher high again, breaking that higher high again. We did test off this high to the left, which got me very interested, understanding that, we could have a good complex pullback and continue to the upside. Now, from the other side of things, this swing low was continuously tested, and key is it was respected. So with price continuously pushing off of it, this is a low that wants to remain intact. So if we're playing in a range like this, I'm really not interested in taking any trades while we're just playing between this massive drop off and this swing low that's been continuously tested. I want to see more bullish market structure before taking anything. So I could have taken this trade right off this swing high, taking a breakout trade right to the upside. But instead, I was a little bit ballsy on this, and I did wait for that complex pullback, some market structure to form, showing me that we are bullish, wait for that retest, and continue to the upside. So not only was market structure on my side with this, my macro was also so on point that it gave me the confidence to take this trade right off these lows. So not only was my market structure extremely on point with this, my macro bias behind the market structure was telling me I could take this position. So taking a trade right off this high and a breakout to the upside, I wasn't hesitating. When the market is showing me clear structure and clear invalidations to the downside and predictable behavior and a macro bias that supports this continuation to the upside, this isn't random. When you see everything lining up from market structure, higher highs, higher lows, clean retests of areas, your macro bias telling you exactly which way the markets want to move, this isn't random. This is the entire market repricing information. And once you understand that, your trading stops being reactive and starts being intentional. And then we can move into the short that I took on November 13th. This was incredibly clean. Barely any drawdown, probably one of the cleanest setups I've taken all year. I made a separate video talking about this, but again, my macro backdrop was so strong on this. Government shutdowns coming to an end. Learning that some of the data was actually lost forever. To me, that is a huge red flag. How bad were those job reports that the data is lost forever? We're never going to see it. With all that economic uncertainty, this AI bubble kind of dragging us down with the stretched valuations, it wasn't hard to see that the NASDAQ was going to be in for a bit of a bearish rip. Now, obviously, from my market structure perspective, so clean. We had such a great area of interest from here being tested 1, 2, 3 times before eventually giving out. And for those who know my strategy already, it is the most simple break and retest model with a strong bias behind me. Once we broke this low, I simply waited on a lower time frame for a retest of this area. We got that, and you can even see right here how I marked out the key opening range of New York session on that day. We broke right below, had a strong closure below. That is a huge key to this, having a strong candle closure below the area of interest. So after the break, we had a very clean retest of this area. Not only was it back into the area of interest, but it was that 15-minute key opening of New York, and then right back down to the downside. This was a trade that was supposed to take a couple days, but it just happened so fast that I really wasn't complaining. Like I said in my past video, I was targeting an Asia session low right here, and this low that had been unmitigated. And I could have held this to the swing low, but I wasn't interested in holding a trade for that long when I've already secured so much profit off this amazingly quick move. Most traders lose because they're fighting randomness, but when you actually understand catalysts, the actual reason price is moving, I'm not chasing candles. And this is why day trading feels so random. Most day traders are trying to make sense of noise. 5-second volatility, algorithmic spikes, liquidation sweeps, micro pullbacks that have nothing to do with real market direction. They're fighting randomness because they're trading noise. But when you step back into swing trading like this, the market actually tells you what it wants to do. Market structure on the higher time frame is so clean. The direction is very clear. Catalysts line up with the trend instead of against it. You know your bias, you know your key levels, you know what the market is waiting for. Swing trading lets you trade the story, not the noise. It lets you align with the actual flow of capital instead of getting chopped in the intraday noise. And once you understand the catalyst behind those big swings, the market stops feeling random and it finally starts making sense. If you guys found this video helpful, make sure to leave a like, subscribe, and give me any topics you want me to go on in depth in the comments section. I'm very happy to do so. But that's going to be the end of this video. I hope you guys learned something. We'll see you in the next one.